You can feel it, right? When it starts to happen. Jobs start getting a little scarce, the markets get shaky, and all the headlines just turn dark. It feels like the whole world is grinding to a halt. And we're told, hey, this is a necessary pain. It's how we fix things. But what if that's not the whole story? What if for some people this whole slowdown isn't a bug, but a feature?
Because that's the real question we need to ask, isn't it? When everything slows down, who's actually winning? Could it be that for some, this isn't a crisis at all, but a huge opportunity? Well, the answer is a big, fat yes.
And it's not some unfortunate side effect of a really complex system.
No, it's not a random roll of the dice from unpredictable market forces. It's baked right into the system. See, an economic slowdown isn't just something that happens, it's a mechanism. And in this explainer, we're going to break down exactly how that mechanism works, and, more importantly, who it works for.
You know the story they tell us. It's simple. Inflation got too hot, things were getting out of hand, so we all have to take a little pain to cool things down. And look, that's not totally wrong. It's just not the whole story. Because under the surface of that simple narrative, something way bigger is going on. And this is the key right here. An economic slowdown isn't like a forest fire that just burns everything to the ground. Think of it more like a massive flood that completely rearranges the landscape. It doesn't actually get rid of wealth, it just moves it around. What it really is, at its core, is a massive power shift. Now, to really get this, let's think back to the good times, the boom. Money's cheap, credit is flowing everywhere, companies are popping up and expanding, and maybe most importantly, workers feel like they actually have some power, They have leverage to ask for a raise or find a better job. But we all know booms don't last forever, and when the music stops, that feeling of empowerment can just vanish. Because when things get a little too hot, the people in charge, the central banks, they slam on the brakes, they raise interest rates. And the goal is to make borrowing money more expensive for literally everyone, whether you're buying a car or a company is trying to build a new factory. Spending cools off, and the whole economic engine starts to sputter. This is the trigger. And right here, this is where everything splits into two completely different realities. This is where the road forks. If you have debt, a mortgage, student loans, credit cards, your world starts to shrink. Your payments go up, money gets tight. But if you have money, if you're the one with capital, then higher interest rates are amazing news. All that cash you have is suddenly making you more cash, and your options are opening up just as everyone else's are closing down. There's a saying that really hits the nail on the head here. That's not ideology, that's arithmetic. It's just simple math. Higher interest rates reward the people who have money and penalize the people who owe it. It's a clean, undeniable equation. All right, so let's zoom in on the corporate world, because this same dynamic plays out on a massive scale. For them, a slowdown isn't just about tightening the belt. It's seen as a cleanup operation. It's a chance to completely reset the balance of power, both between competing companies and between the bosses and their employees. So here's how it goes down. Step 1, all those weaker companies that were only staying alive because of easy loans, they go under. Poof, competition thins out. Step 2, the big, cash-rich companies can now swoop in and buy up their struggling rivals for pennies on the dollar. Step 3, with layoffs on the rise, the power shifts. Suddenly, employers hold all the cards in wage negotiations, not the workers. And finally, step 4, the companies that make it through emerge stronger than ever, with fewer competitors and way more control over the market. They call it increasing efficiency. In reality, it's a power grab. And for the average worker, well, this chart says it all. During a boom, when jobs are plentiful, you've got bargaining power. You can ask for more. But during a bust, when jobs are scarce, well, employers pretty much dictate the terms. A slowdown is a quiet but incredibly effective way to reset who has the upper hand in the entire economy. Okay, let's pull the camera back even more, to the global stage. Because this isn't just about you or me or some company down the street. The very same sorting mechanism happens to entire countries. A global slowdown is like a giant stress test that protects the already powerful nations and just hammers the fragile ones. Look, if you're a country with a strong, stable currency, you can pretty much weather the storm. You can borrow your way through it, wait it out. But if you're a weaker economy, it's a total catastrophe. Foreign money flees, your currency's value collapses, and suddenly the debt you owe in other currencies explodes. It's a brutal cycle that can set a nation back for years, and the gap between the world's haves and have-nots gets way, way wider.
So you start connecting the dots, right? The shift from debtors to creditors, from small companies to huge ones, from workers to bosses, and from fragile countries to stable ones. You start to see a very clear pattern. These slowdowns aren't accidents. They are a predictable, maybe even essential, feature of how our whole economic system is designed to work.
There's a quote that just nails this idea perfectly. Booms make people question hierarchies. Busts remind them where power sits. Think about that. When times are good, people start to challenge the status quo. Busts, they have a hidden function. They restore discipline. They're a stark reminder of who's really in charge.
And when you lay it all out, the outcome is, well, it's incredibly predictable. The winners are always the same. People with cash, big institutions that can afford to be patient, companies with leverage, and countries with strong currencies. And the losers? Also the same. People living paycheck to paycheck, small businesses drowning in debt, young people trying to start a career, and nations who made the mistake of borrowing in someone else's money. The slowdown neatly sorts everyone into one of these two columns.
And that brings us full circle back to what they tell us. When a politician or an economist says a slowdown is necessary, they might be right, but they're leaving out the most important part of the sentence. It's necessary for the people who are already on top. It's necessary to reinforce the power structure that's already in place.
So I'll just leave you with this final question to chew on. If the pain is this predictable and the winners are always this consistent, then isn't economic slowdown really a failure of the system? Or is it the system working exactly as it was designed to, as a quiet, brutal mechanism that decides who gets to survive and who gets to thrive in the next cycle?